Guess what? The IRS is coming, and they're coming for real estate investors. Here's what you need to know. Here are 6 ways to avoid IRS audits if you invest in real estate. Here's the thing. A big percentage of Americans overpay in taxes every year. And one of the main reasons for this is simply fear of the IRS. We are all deathly afraid of the IRS and of tax audit. But the reality is, does it have to be that scary? Sometimes the fear itself is more scary than the reality. And if we think about it, what are some of the common reasons why we fear the IRS? Actually it comes from a couple different sources. If we think back to when we were growing up, our parents probably feared the IRS. And so when we hear our parents talk about how scary IRS could be and audits and things like that, we are programmed to then also have that fear of taxes and of the IRS. Another reason we fear the taxes and the IRS is the media and even maybe social media. We always hear in the media where they talk about how wealthy people pay no taxes, but everyone else loses so much money to taxes, especially middle Americans. But what we are taught to believe in that kind of messaging is that there's not much we can do to save our own taxes. We're almost victims to the system, the whole it is what it is narrative. But it doesn't have to be this way. As you know, with strategic tax planning, there are ways that we can take control of how much taxes you pay. And the third reason we're afraid of the IRS is actually because your CPA is probably afraid of the IRS. How many times when you're meeting with your CPA or doing your tax returns, will they tell you that you can't do this because of an audit? If you claim a home office, you'll be audited. If you do accelerated depreciation, you might be audited. So with all these different messagings from our parents, from the media, from our CPAs, it's no wonder Americans are super fearful of the IRS. But the reality is the IRS is not that scary. And in fact, in all the years of working with auditors on client cases, I can tell you that most auditors are very reasonable people. They're very intelligent people as well. It's important for us to understand that they are just individuals doing their job. Part of their job, of course, is to make sure that you're doing things correctly. And that gets to the heart of the matter, which is if you're doing things correctly, you really should not have this unreasonable fear of the IRS. Now, the reality is the IRS did just get a whole boatload of money from Congress, and a lot of that is intended to increase audit efforts. And they have signaled that a lot of these audit efforts are going to be directed towards real estate investors, high-income individuals, and high net worth individuals. Even though we should not fear the IRS, we should be aware of what the powers are within the IRS, and more importantly, understand what our responsibilities are as taxpayer. Now, I'm not saying we're going to hide under a rock and not write off anything and be super fearful, but I am saying that we want to be proactive. We want to be strategic in how we do things, how we document things, and be able to have the right fact patterns if we are to be audited. Believe it or not, how you file your tax returns, how you report your income, how you operate your business, and how you operate your real estate all play a very major role in how to minimize audits and how to protect yourself in the event of an audit. Let's go over the 6 major ways we can protect ourselves from an audit, and also, just as importantly, what can we do if we're actually audited? All right, the first thing that we must do to lower our audit risk is to make sure that we provide all of the right documentation to our tax preparer. This is so important, especially with today's technology. There are a lot of documents that are automatically matched to the IRS. And so, for example, if you got an interest statement, if you had a W-2 statement that you didn't send to your CPA, thus not report on your tax return, there's almost a certainty that you will get an audit or at least a notice from the IRS asking you for payment on that. And that's just such a simple thing we can do. We wonder, is this something I should send to my CPA? I just really don't know. What I always tell our clients is when in doubt, make sure to share that information with your CPA, because the worst thing that could happen is they don't use it because it's not necessary. But if they don't see that document from you, there's almost 100% chance that that will be missed, and then you're likely asking for an audit. Common things, even, like if you sold your primary home and you don't have to pay taxes on it, still send that 1099 to your tax preparer, send them the closing disclosures because they should still be reported on your tax return. Or or if you had some money that you received but you were not sure if that document will mean you have to pay taxes or not, those are great things to make sure you provide it to your tax person and have a discussion with them about that. All right, the second thing that you must do to minimize your audit risk is to make sure you file on time. Now, I don't mean you have to file by March or April. You can certainly go on extension. For entity returns, we have until September 15th usually, and for individual returns, we can usually extend until October 15th. But the key here is we want to file on time. So if I don't have extensions, I want to file by March and April. If I do have extensions, I want to file by September and October. IRS loves to audit cases of people who file their tax returns late, meaning beyond the extended deadline. And, I don't really know the exact reason, but I would imagine it's because there's probably a high likelihood that people who file returns late means they have bad accounting records. And those are low-hanging fruit and easy targets for the IRS. All right, the third thing that we can do to minimize our audit risk is to be proactive in how we file tax returns. Schedule C on a personal tax return for sole proprietorships, that's one of the biggest audit areas that the IRS loves to look into. If you're someone with a side hustle, if you're selling stuff on Amazon, you have real estate commissions, you're doing property management, you're wholesaling, you're flipping, all those types of income, we generally recommend you earn that through a legal entity. The reason being, if you're filing as a Schedule C on your personal tax return as a sole proprietorship, and we have high sales income or high net losses, there is a much larger percentage or likelihood that it'll be audited versus if you just strategically file that on an entity return, an S corp or partnership, then your odds of being audited are reduced significantly. So this is what I mean when we say how you file your tax return could play a very integral part in terms of lowering your audit risk. All right, the fourth way to minimize your audit risk is to make sure you issue the right documentation, and specifically 1099s. So we often hire contractors and cleaning crew or repair guys to come help with our rental properties, whether it's regular rentals or Airbnbs. And sometimes we may forget to issue 1099s. Although not issuing 1099s does not mean you can't take a tax deduction, 1099 issuance is nonetheless a compliance requirement. So to the extent you're required to, we always recommend our clients to issue the required 1099s. An added benefit of doing that is that you can lower your audit risk. When IRS sees a large expense item of you paying out somebody and they see an associated 1099, it's an easy way for them to match those things up and be able to substantiate a deduction. The fifth way to minimize your audit risk is in the numbers that you're using for your tax return. So two big things here, guys. One, no round numbers. We don't want to have exactly $20,000 of car expenses or $15,000 exactly for depreciation expense or $30,000 for marketing costs. You want to use actual numbers, and usually the actual numbers are not super rounded numbers like that because there are sales tax associated with it and other fees associated with it. So we want to use actual numbers. And along those things, the second thing to be aware of in terms of claiming expenses is we want to have good categories. Good categories. Marketing is a good one. Repairs is a good one. Professional development is a good one. We don't want to use generic categories like miscellaneous expenses or other expenses, or one of my least favorite ones, credit card expenses. Those tell the IRS this is a dump account. This is an account where we have all sorts of stuff going in that we don't really know what it is. And that's one of their favorites to open up if you have large round numbers in these generic account descriptions on your tax returns. So avoid those at all costs. The last thing that we can do to minimize our audit risk is simply to have good bookkeeping. Bookkeeping is almost like the bad word, right? It's a thing that nobody likes to talk about, nobody likes to do. Do I really have to have the receipts? Do I really have to record all these things? And the answer is yes. Bookkeeping is the foundation to having effective tax planning and also audit support. Because guess what? If you're audited, the IRS is going to request books and records. That is how they know where you spent your money, where it's coming from, and what did you spend it on. And those little receipts are going to be your insurance policy to being able to prove what are the details behind each of those. As boring or burdensome as bookkeeping may sound, it is important to have good books, especially nowadays, because they are a buffer point between you and the auditor. They will help to deliver the correct and appropriate message, put you in the best light so you have the highest success success of winning an audit. Just like in real estate, where you don't want the seller to be there at the open house, it works the same way here. Don't talk on your behalf. Always seek out representation if possible. Good records go a long way. If you're actually involved in an audit, make sure that you are giving them the right documentations and everything is referenced and cross-referenced so you make the auditor's job easy. We don't want to throw them a shoebox of receipts and make their life hard, because then they're going to get angry and they're going to pick at all sorts of things, right? We want to have everything buttoned up in binders with labels or in the right files with the right color code to make their job easy, to match up numbers and agree with what you are deducting and what your tax position is. Last but not least, just be nice and be professional. Like I said, IRS agents are normal people just like you and I. They are not monsters. They are not out to get you. They're just making sure, or their job is just in making sure that you are paying taxes on the appropriate amount. So being professional, being courteous always goes a long way. And one thing we always do when we work with auditors is to make sure you know how to make their job easier. And that goes a long ways when you are working together on resolving an IRS tax matter. If you like this video, be sure to hit the like button and subscribe. And if you want more tax saving strategies, check out the description to access our free tax savings toolkit.